Great. Thank you so much. Hi, everyone. Our topic today is a real estate developer's guide to operationalizing risk management for scalable growth. And really, really excited to get started on this topic. It's going to be a lot of information, and we also have some solutions that we're going to provide for everyone today, too. Our agenda, we're going to start by talking about the new risk reality and some of the new market fundamentals. Then I'm going to outline 5 different market risks and offer some solutions about how to overcome them. Haley's going to help out with that, and she's going to provide some demos of some Northspire programs that can help kind of address some of these issues. And then we will have time for Q&A at the end. So please send over your questions if you have any along the way, and we'll answer all of those for you. So the impetus for this guide was really this kind of new market environment that we're in. We're calling it the new normal. But the pandemic really set off a new market cycle. And it's so interesting because there are a lot of reasons why a new market cycle might start. And the pandemic, I think, is just your quintessential black swan event, right? No one could have seen that coming. You could never have anticipated that that was going to happen, but it really fundamentally changed the market conditions in a lot of ways. And I think it's interesting to see a black swan event like the pandemic happen because there has sort of been this idea that we would go back to some kind of pre-pandemic life. And I think it's now 5 years past the pandemic, and it's time to kind of say that we're not. We really have to kind of understand the new market dynamic that we're in, very, very different dynamic than we were in pre-pandemic. And we need to kind of embrace a lot of those changes and strategize around them. This new market cycle is marked by a few kind of interesting characteristics: higher borrowing costs, shifts in user demand, new migration patterns, rising construction costs, and some labor challenges as well. Um, One of the reasons I think that we have seen this kind of shift in, or this, not the shift in the market, but this wanting to kind of go back to the before, or really waiting. A lot of that has been, we've seen capital moving to the sidelines. And a lot of that is because we're in kind of a bifurcated recovery, right? When you look at some fundamentals, you see significantly higher borrowing costs and also some volatility around borrowing costs on the bank side, some of those liquidity constraints, some challenges around construction materials and construction labor. But you also see other fundamentals that have returned to kind of pre-pandemic norms. Employment is one of those. You've really seen, really kind of a shift in employment during the pandemic. You can see this graph here shows kind of coming off of 2021. Obviously, employment spiked in 2020 and then kind of fell in 2021, 2022. This year, we've seen some unemployment rate tick up, but still at 4.2%, a very, very healthy unemployment rate. Obviously, a very important metric for developers to kind of track where employment's going to be across asset classes to set pro forma rents and cash flow and demand. And then when you look at GDP growth as well, you saw that dip during the pandemic in 2020 and 2021. But since then, GDP has been back on its traditional growth trajectory that we have seen since 2015. So I think when you look at some of these metrics and you do see the markets shifting back to where we were before, it's easy to expect maybe some of those other metrics will follow. And I don't think that's necessarily the case across the board. Developers obviously kind of acutely exposed to some of these changes, and we've seen a lot of that in the new construction pipeline. Really kind of across asset classes, you've seen new construction starts falling. Non-residential spending has been down 6 of the last 7 months this year. Office construction is only at 7% of current inventory. That's a 10-year low. We can see the retail pipeline here, only 0.3% of inventory, so very low retail development. Here's multifamily is also just below 4% of current inventory. We had record deliveries in 2024 and really record new multifamily development for the last few years. So some of the multifamily numbers are really just kind of cycling through that new supply that had come online, and giving the market some time to absorb it. I anticipate that we'll see multifamily maybe bounce back faster than some of these other asset classes. Here's the office construction pipeline. You can see that dip as well. This is actually a global graph, so it's kind of interesting to see where office construction is at globally. Um, and then you do have some interesting increases in new construction and some other asset classes. Industrial actually is the only of the kind of four major asset classes to see a rebound. And some of those niche asset classes like data centers have also seen really, really strong construction rates. A lot of that's driven by AI. But kind of across the board, you have seen this kind of volatile and uncertain economic environment really weighing down on new construction activity. I really wanted to point this out. This is now, I'm sure we've all followed it, this infamous unemployment or employment graph that came out in mid-July, right after the Fed's meeting, where they did not raise interest or do anything, did not lower or adjust interest rates again. And then there was this kind of jobs report that came out with only 73,000 new jobs added in July. That was really, really very far under expectations. And then the report also adjusted May and June's numbers. So you actually saw this very weak job market for May, June, and July, really outside of expectations and kind of shocked the market. There was interestingly, and this is why I wanted to call this kind of a catch-22, there was interestingly kind of excitement around this job report because I think a lot of people in the development industry and definitely in any kind of investment market took this to mean that there would absolutely have to be a rate cut in September. It looks like that probably is the case, but I kind of wanted to point out that for a rate cut to happen at this point, you need to see something like weakening fundamentals in the job market, which is never good news in commercial real estate, never good news in new development. You really need strong job numbers to support new construction in any kind of asset class. And so I think that while we may see borrowing costs come down in September, that we may also have, there may also be some difficulty underwriting projects when you see job numbers this low, right? It's going to really affect pro formas on any new project. And so I think it's important to understand this kind of dynamic that we're in, where it's not just about waiting for interest rates to come down, because if rates come down, we're sort of looking at other challenges. And this is why I think we need to kind of adapt to this new risk reality. And a lot of that is really just understanding the current economic environment that we're in, being able to understand the risks and respond to those risks in a strategic way, and then kind of mitigate the impact of those risks. This is kind of how we can adjust and still be active in the new market and kind of absorb some of these risks into new project profitability and investment profitability and kind of carve that path forward. This is what we've called operationalizing risk management, which is really just kind of creating a response system internally that can respond to those risks. So that is kind of navigating rapid market shifts, integrating being able to integrate new risks quickly into your system, and creating a strategy and an underwriting strategy that can respond to those risks. And the way you do that is to really build a clear framework to identify team members that can be responsible for identifying these risks by defining their roles, creating best practices, and really conducting kind of routine risk checks as market conditions evolve. And it's kind of important to say this is kind of great to have in any market cycle, particularly in the current market cycle where we've seen a dramatic shift in fundamentals, but certainly in any market cycle or any time a market cycle is changing. If you have kind of this operationalized risk management system in place, you will really be able to absorb those risks better and respond better, and then be more competitive, I think, on the back end. It's important that this is kind of happening throughout the life cycle of a development project, really kind of promoting life cycle thinking, excuse me. And that's for, during the acquisition process, when you're selecting a site, when you're vetting prospective sites, early planning, pre-construction planning, pre-development, actual construction, and then through delivery and stabilization of the asset. So, really kind of important to think about operationalizing risk management throughout the life cycle of a development project. And we're going to talk about now some of the kind of common market risks that we see. There are really no shortage of market risks, I think, for a developer. Developers are kind of inherently risk resilient, right? They kind of take on a lot of risk in general when you're building a project. But I think that these are probably the five market risks that you would hear developers talking about the most. It's elevated interest rates, rigid lender guidelines, labor shortages, volatile materials costs, and then permitting delays. We're going to go through each of these five right now, and we're going to also offer some solutions of how to respond to all of these risks that you might be experiencing in the market. Let's start with elevated interest rates. We're currently seeing high financing costs. This has happened since 2022 when the Fed began kind of aggressively increasing interest rates. Now we're seeing kind of construction costs. You'll see here almost double what they were, construction financing costs almost double what they were pre-pandemic. And we really haven't seen the cost come down this year at all because of some other outlying factors, tariffs and inflation have still been high. Tariffs have put some more pressure on inflation. And so the Fed this year, through the first half of the year, has chosen to keep rates steady. And that has really put a lot of pressure on borrowing costs for developers. I have this chart here because the prime rate always tracks the Fed funds rate. You can see here since 2015 how those rates have tracked together. And the prime rate always kind of sets the baseline rate for borrowing costs. So was a little dip at the end of 2024, but we still continue to see elevated interest rates in the market. There are some expectations that rates might come down at the September meeting if the Fed adjusts rates, but I think that it's important not to get too excited about that, really because of the job report, like we just talked about, but also I think, you don't know how much rates are going to come down and if this is a one-off rate reduction or if we'll see multiple reductions after that. But even if rates don't come down in September, you can sort of adapt to a higher interest rate environment through predictive budget management. And I'm going to kind of kick it over to Haley right now, who's going to show us a demo about how some of these programs can help you absorb higher construction costs into your budget. Haley?
Thank you, Kelsey. I will share my screen here. All right, so right now we're looking at Northspire's anticipated cost report. This is really a decision-making tool that you can use to make better and smarter decisions because you're forecasting these potential exposures that Kelsey alluded to, 3 months from now, 6 months from now, 1 year, 3 years from now. All of that is here for you to, again, be able to make better decisions moving forward on your project. So up at the top here, this overview, this is a really nice comprehensive view of a project's financial health. So, an executive of your organization can come into the anticipated cost report and really, be able to high level understand what this project's financial health is just by taking a look at this overview. Down below, there is a much more, robust and detailed table here. We often refer to Northspire as like peeling back an onion, like the deeper you dig, the more layers you uncover and the more information and insights you can gather. So you'll notice that there's some green and red on this table, and that basically is identifying where there are opportunities and risks. So obviously where there's red, we want to pay special attention. Just taking a look at this like architect of record budget line as an example, I can see that I have a $512,000 variance. And that's because my total anticipated cost for the line is much higher than my budget. And if I want to kind of dig into why that is, I have this $326,000 exposure mark here. I can actually click into this value and start to unpack what are, the exposures that are feeding into this variance. And so here I have an index to list. I can take this a step further, look at the specific PCO, who added it, when, any approvals that occurred, and so forth. Another great solution is our project cash flow feature. So this is where you're going to be projecting basically your spend projections for the life cycle of the project, all the way from, again, due diligence to delivery. And again, as risks crop up, maybe sooner than expected, you're proactively understanding when you're going to need to potentially raise money, or there's a risk that your lender needs insight into. And so all of that data is here available to you. The line here represents the current month. Everything beyond is our actual spend. So not just looking at projections, but also looking at how our actual spend is impacting our future projections. And then, of course, in front of the line, the blue are our projections. I can even click into any of our actual lines and see all of the invoices in a given requisition period that we're feeding into that month's spend. And this gets manipulated in the table below. So by establishing a start date, end date, and curve fit for a given budget category or line, I can, again, help inform these projections to stay ahead of risks and concerns. All right. I also wanted to point out our cost analytics feature. So this is kind of taking everything I just spoke about and rolling it up to the portfolio level. So not only can you use the ACR to get a really good understanding of what a specific project spend is, you can also look at your analytics across your entire portfolio. So in this case, I'm looking at the project architect, but you can look at any scope of work here using this dropdown. You get a really good understanding of, what is my average budget overrun for this scope of work? What percent of hard plus soft costs does this cover? What is my average cost per unit on this given budget line? So all of this data is just really helpful for forecasting and budgeting future projects and understanding risks. So looking at our change overview here, I can see that I can get a really good understanding of what are the types of changes that are causing this 11% budget overrun. In this case, it looks like design changes, owner changes, and then some other uncategorized items. But yeah, so some good insights there. And then down below in this table, again, going back to that onion analogy, we can really start to peel back the layers. I can see all of the specific projects that are feeding into this data set, take that a step further, see all of the specific budget lines, which ones specifically have variances, etc. Another thing I failed to mention is that you can look at subsets of projects as well. So not just your entire portfolio, but maybe you want to look at a specific region, a specific asset type, a specific year, etc. So you can look at the analytics for those items. And with that, I'll kick it back to you, Kelsey.
Thank you. That was great. All right. Sorry. All right. So the next kind of risk that we've identified is rigid lender guidelines. I think this is a really important one. 68% of developers that have been surveyed have said that they have experienced project delays due to financing constraints. And we've seen construction volumes kind of trending down since 2022, which really aligns with when interest rates kind of started to tick up. So there's a real direct correlation here between the cost of financing, the availability of financing, and then what kind of construction projects are getting done and getting secured. You can kind of see this graph here really shows construction spending versus financing constraints. And you can see kind of origination volumes versus the kind of all-in rate, and then also kind of across different types of new construction activity. Spending has ticked up slightly this year, as have origination volumes, but you really saw that kind of downward trend from 2022 to 2024. And I do think in this year, maybe you're starting to see I think a little more optimism around where interest rates are headed, particularly coming into the year, because we were coming off of several rate cuts at the end of 2024. And then I just think that there's maybe as we get kind of further away from the interest rates, the interest rate increases, we've seen just some maybe acceptance of the current market conditions that we're in, which might be why we've seen a little improvement this year. But you really do kind of see on this graph how rates have changed dramatically. I mean, how construction volumes have changed dramatically in correlation with where rates are. And interest rates are an interesting thing because that obviously affects the cost of capital, but it really also affects the lender's appetite for risk as well. And so I think when you see rates tick up, you also maybe see a pullback of liquidity. So there's kind of a balance here between being able to afford the cost of capital or absorb that cost into your budget, but also being able to secure that capital. And that's kind of what we're talking about here is the lenders that are really able to lend on a project. And there are some kind of key steps to winning that funding. I think that it's important to kind of lean into the banking relationships that you have currently. And I say this all the time because I think that there's maybe some misunderstanding about what a banking relationship is, but that can even just be the bank where you have your business account. That's an existing relationship. And I think banks are always looking to work with existing clients and expand those relationships. So that's an important one. I think accepting lower loan to cost and loan to value, or at least finding a way to maybe create a capital stack where you can have maybe a little more equity in a project. That obviously can help get a lender comfortable. And then really providing transparent documentation, right? A lender wants to know what the project is, they want to know what their risk level is, and they want to know that they're working with a borrower or a sponsor that kind of is able to guide this project to its end goal and meet those end goals. And a lot of that comes through really being able to tell the story of the project and provide the documentation that is needed. To kind of show where you're at in the project, tracking the project's progress, and really sharing that with the lender so that you're building a relationship where they feel really comfortable in working with you. This is kind of key to where you can find a solution, kind of through lender and investor reporting and through transparent documentation. I'm going to hand it back over to Haley, who can show another demo of this software as well.
Thanks, Kelsey. Let's start here. Yeah, so as Kelsey mentioned, I think, Northspire can really help with creating and maintaining those lender relationships by having really transparent documentation that is like as easy as possible for you to put together. So this is our draw request feature. You can see we have the current requisition period, some quick stats up at the top here. We have our full table and report here below. But I want to point out our Draw Copilot. This is a recent addition, which is really, really valuable, I think, in making sure that your report is always tight before it's submitted. So basically here we're flagging any budget lines that have overruns for you, any invoices that are missing backup documentation, any contracts that are being over invoiced, any missing insurance, lien waivers, and then any funding sources that are not sufficient to cover your uses. So if we click into any of these, you can see I have automatically all of the budget lines identified in this example where overruns exist. I can fix them all at once as an option. That would create the reallocations for me. I can go in one by one and look at them in a more detailed manner to make sure I'm, maybe I don't want to do the fix all option. I can also ignore a specific case. Maybe it's an exception and I need to ignore it. But again, flagging all of these proactively so that you can make sure all of your T's are crossed and I's dotted before you submit your draw request. This also gets wrapped up into a nice lender compliance report that you can put at the top of your draw request report. So basically just, your lender also understands that you've checked all of these items before submitting it. And they can really feel really confident about what you're submitting. And then, of course, beyond that, we have the draw request itself. So the table that Northspire generates, the invoice list, and then it would follow with all of the backup documentation as well. And of course, all of that's happening kind of being smartly indexed as you're processing invoices through our AI-enabled data inbox, which we'll look at later. So very little lift on your end. Another option we have is our funding portal. So let's say as an alternative to simply submitting the PDF report to your lender, you instead want to shed some light and give them access to the tools that you're using. So this funding portal is basically where you can share or generate a link to share this page that we're looking at. You can obviously select here which of the cards you want displayed for your lender to see. and share that with them. They'll be able to access this page. Obviously, without any of the top navigation, they won't be able to go anywhere else, but they'll be able to see, your cash flow projections here live, the sources and invoice overviews, and then all of your current and all of your past draw reports available for download. All right, and with that, I'll kick it back to you, Kelsey.
Thanks, Haley. I think those are so exciting because I hear so many just in my reporting, so many lenders saying, that they want to be a partner with the developer. And so I think when you kind of can so easily make them a partner, right, by sharing this documentation, I think that that's a real winning strategy there. So thank you. Next risk is labor shortages. I think every developer has had to kind of deal with labor shortages. Um, it's one of the most challenging risks, I think, or challenges that exist today in the market. You see kind of 1 million fewer workers. So these are some interesting stats. The worker shortage really started, I know we're kind of talking about this pandemic shift, but it really started during the great financial crisis back in 2007 and 2008. There was really kind of an exodus of development and exodus of workers. And the market has really never recovered since then. So this was interesting to see that there are 1 million fewer workers today versus 2007. And then the workforce is down. That's an 11% reduction since 2007. But then since the pandemic, the workforce has actually shrunk again another 2%. So we were already in this labor deficit that was very, very severe and was already putting upward pressure on labor construction costs. But the pandemic really exacerbated that problem, right? You saw more exodus of labor leaving, going to other projects, other fields, other industries, and that labor never returns. So as a result, we've seen skilled labor costs up nearly 5% just in the last year. Common labor costs up 3.1% in the last year alone. And these are really significant challenges for developers. You can see this graph here that shows kind of the costs across labor expenses. And these have been challenging for developers to absorb. Kind of in partnership with that, you also see kind of volatile materials costs and materials costs rising, right? So you're really, from a construction pricing perspective, you're really kind of challenged on the labor side. And that is a very difficult challenge to solve because it's really a labor shortage. And then you're also seeing rising costs on the material side as well. Materials prices up 43% since 2020. We're seeing today. So materials costs are up 43% since 2020. And a lot of that happened because of massive global supply chain disruption. There was a lot of hope that that would kind of even out as we moved away from the pandemic and supply chains recovered. But I think the introduction of the tariffs this year really kind of threw a wrench in some of those plans. So you're now seeing materials prices increasing again, particularly for materials that are purchased overseas, obviously. So 40% of all materials are purchased internationally for construction projects. And inflation, or not inflation, but tariffs will increase those costs. But then you'll have inflationary pressure, natural inflationary pressure on domestic goods as well, just because you're going to see an increase of demand for those domestic goods and just not enough supply for them. So you're going to see some inflationary pressure on domestic goods as well. Maybe not as significantly as international goods, but I think we're going to see cost increases happening overall this year. There's an anticipation that tariffs will increase costs up to 10% this year. Not a lot of data on domestic materials, but I know that there are a lot of concerns about shortages for domestic materials. I pulled this chart from Cushman and Wakefield, was just published last month, so relatively new, and it really kind of shows the price increase across the different types of materials: aluminum, steel, glass, lumber, gypsum, concrete, kind of all of these different materials that are commonly used in new construction projects. And you'll see the really dramatic cost increases, sometimes 50% or more for some of these materials. And I think the best way that you can kind of absorb and respond to some of those risks and kind of mitigate the cost increases is through vendor management. I'm going to hand it over to Haley once again, and she's going to show another demo about some great vendor management tools through the North Spire platform.
Thanks, Kelsey. Yeah, so one of the things I think, one of the ways in which we can offset some of the risks that Kelsey was alluding to with, higher labor prices, obviously going to drive up the costs of your contracts with vendors, is by competitively bidding your scopes of work. So one of the things Northspire AI is going to do for you is flag scopes of work within your budget where there's a predicted savings if you do choose to competitively bid out that scope of work. And then we take it a step further and make it really easy for you to do just that. So if we look at this MEP engineer where there's a predicted savings of 42,000 if you do uh, like issue a competitive RFP. We have some recommended vendors for you, even from our vendor marketplace of over 15,000 vendors that you can invite. You can, of course, always use your own vendors as well. Um, so looking at taking that a bit further, let's say you do go ahead and create that RFP in Northspire, invite vendors to bid. Another thing that Northspire AI is able to help with is reviewing proposals. So in this case, I have two proposals that I've received for interior design. Here you're going to see flagged for you whether there's going to be a savings or an exposure based on how the proposal compares with your budgeted amount for this line. And then looking at the proposal in more detail, we have the proposal here on the left. Northspire AI is going to flag all of the potentially missing scope that is identified in this proposal for you. And then you can choose to send these recommendations back to your vendor. You can open up another round, request best and finals, and make sure all of your vendors are considering the potentially missing scope that's been flagged for them to, prevent any costs that could come down the line by the fact that some of those items were missing. We also have a bid comparison page here. So in this case, we have the two vendor proposals side by side and all of the potentially missing scope in each. All right, so moving on from bidding, we also have some other vendor tools which are really helpful to understand just where things stand, both at the project and portfolio levels. So right now we're at the project level. This is the vendor overview. So there is a overview for every single vendor on a given project that you can select from here in this list. So you get a really good understanding just of where they their percent complete on this project against their contract, their projected versus contracted amount or cost per unit. We also have all of their documents smartly indexed here. So any contracts, change orders, any exposures, and any invoices that have been processed on the project, all very smartly indexed here for you to find. And then, like I mentioned, taking that to the portfolio level, we have our vendor analytics tool, which is similar to cost analytics, but looking at a vendor instead of a budget line. So you can select between all of the vendors you've used across all of your projects and start to understand, what is the average overrun for this vendor. And then moving over to the cost overview, you can start to understand. In this case, we just have one cause, which is probably a good thing, considering what it is. Unforeseen field conditions is, probably a valid cause for change in many cases. And you start to unpack and see across your broader portfolio, like why is this vendor overrunning their contract, and do I want to use them again on a future project? Do I want to alert them to the concerns I have so they can, improve or step up their game in the future? And then down at the bottom here, again, I have all of the specific project data that's feeding into these numbers. And then similarly, you can always break this down by portfolio grouping, so you can filter it down from all projects to any subset of projects that you want to look at apples to apples. And with that, I'll flip it back to you, Kelsey.
Thank you. That was great. And then this last risk is really about permitting delays. I think every developer experiences some kind of permitting delays. I am based in Los Angeles, so I think I might know the most about permitting delays. It's what we're known for in the city if you're building here. But really kind of a problem across the country. Definitely varies though depending on your location, the location of your development. But 81% of developers report permitting delays on their project, and it honestly can significantly increase the cost of a project, right? Carry costs on a project are significant, and you're really kind of hitting the pause button when you're waiting for permit approvals. And sometimes it's not just permits with the city. There are kind of a variety of things that you have to go through. Sometimes it's public comment or community comment. Sometimes it's the entitlement process. And so all of these can take time, and they can really increase the cost of a project. I think that as we've seen local municipalities overwhelmed, the permitting process has been extended for a lot of developers, which is why so many are kind of reporting these delays. And some states have done reports on this. Washington State has seen 1% cost increase for every single month that a project is delayed in permits. So that's actually pretty significant. If it takes, 6 months even only, which I think some people might say is a pretty quick permitting process, but to see that kind of 6% cost increase while you're waiting for permits to come through is significant. New York did a report for residential projects, and delays can increase the cost of a unit up to $50,000 per unit. So there are real kind of cost consequences to letting a project sit in the permitting process for too long. And luckily, we have kind of dynamic scheduling and document management tools that can really help developers anticipate some of those scheduling challenges and actually find solutions around them. I'm going to hand it over to Haley so she can show another demo about how to use these tools as well.
Thanks, Kelsey. All right, so right now we're looking at our schedule feature in Northspire. This is a robust scheduling tool where you can also collaborate with external partners. So we have a full Gantt chart, baselines versus actuals. There's also the ability, like using the permitting case as an example, the ability to collaborate with external parties on a given milestone in your project so that you can sort of eliminate some of those communication barriers and break down silos. So let's say, as an example, we wanted to directly share this permitting milestone with our expediter so that they can then basically be in charge of updating and owning progress. You can share with external parties either as a viewer or as an owner, but in this case, help break down barriers, share it with them as an owner, and then they can make sure that that is kept on track and you have the data as quickly as possible real time here in your system of record. Another way that Northspire is really helping with schedule management is just by the efficiency of document management and getting invoices processed and paid. So right now we're looking at our data inbox. And if it wasn't clear before, this is the primary way in which data is getting into the system. So in our anticipated cost report, our draw request, none of that's having to be manually entered or uploaded. It's all flowing through our data inbox here. So this is where invoices, contracts, insurance, lien waivers, and any like non-financial related documents show up as well, as long as they're emailed into your project email. And if we click into one, you can see the invoice PDF on the left. You can see all of the data that Northspire has extracted from the PDF on the right, as well as the AI assigned budget line as well that we used, based on the budget lines that invoices are going towards, we can predict which one incoming invoices should go to. There's also a co-pilot analytics feature. So going back to kind of just like mitigating budget risk on your project, we can see all of the relevant impacts here that this invoice is going to have on the project. So the overall budget impact, the overall vendor impact, the specific commitment impact, and then even the source impact if this budget line is associated with a specific source. So flagging all of those, and you can see obviously some are in red and amber, which you might want to take a second look at before accepting this invoice. All of that's here proactively letting you know, so you can make faster decisions, get invoices approved, keep vendors paid, and moving along, not causing delays on your project. We also have approval workflows, of course, available to you as well, so you can have all of the relevant parties that need to approve here in place to do so. All right, and then lastly, we have a handful of data indexes. So Invoices, commitments, budget transactions, COIs, sources, and lien waivers all have a data index. So let's say an invoice does go missing, hasn't been paid, you need to track it down. All of that information is smartly indexed on each project. So we can click into any invoice. We can also filter by any of like the respective invoice attributes here to help cipher through this data. But when we open one up, you get the relevant PDF, all of the pertinent information, who approved it, when they approved it, any payment history as well. So again, all of that kind of data at your fingertips so that documents don't get lost and your schedule remains on track. All right, I'll kick it back to you, Kelsey.
Thank you. And so those were kind of the five risks that we wanted to outline. Again, there's no shortage of risks, but we really wanted to show that there's a response system to each of these risks, no matter what that there are. And it doesn't have to be, you know, this kind of massive undertaking of the firm to operationalize risk management into your system. I think it's about having kind of that right toolkit, like all of these tools that we showed you, really leveraging new and emerging technologies and really kind of incorporating those tools into your system so that you are kind of mitigating or responding to risks kind of at every turn throughout the life cycle of a project. You can do this on a single project or across projects. And, it's really kind of creating this systematized approach. And when you operationalize risk management, you create opportunities and you can unlock opportunities in both kind of down cycles, which I don't think I'm prepared to say we're in an actual down cycle right now, but we are in an unusual cycle. And I think that it has created this kind of stall for a lot of developers. And so this is an opportunity to say, no matter what kind of cycle we're in, whether we're in kind of a bear market, a bull market, or this kind of in between that we're in now, there's an opportunity here to use that right tool set to identify and respond to risks, and then and still be able to kind of break ground on new projects. Thank you so much. We do have time for Q&A if there were any questions.
All right. Thank you so much, Kelsey. Thank you so much, Haley. We did have a couple questions come in, and we have time for one of those questions. And this comes from LER. And the question is, given the stringent lender guidelines of the last few years, is it expected that private funding will continue to fill this vacuum, especially if the expected interest rate reduction doesn't occur?
Yeah, if private funding will kind of fill in the vacuum. I wonder if on the debt or equity side, I I I mean, my personal opinion is I do think that there is plenty of private funding opportunities. The thing is that I think the number is like $7 trillion of dry powder that's sitting on the sidelines. And we're in an interesting dynamic market right now because in 2022, really kind of before this, I mean, I guess interest rates started to rise in March of 2022, but there was kind of historic fundraising activity, right? Kind of in those early pandemic years, before you saw this stall in activity. And all of that money has not been placed yet and still needs a home to land in. And so I think you've seen that capital looking for a place to go. And a lot of that has come through kind of private funding on the debt and equity side, filling in gaps in the capital stack. I think there are a lot of lenders that are also launching private debt funds to do a lot of that, or to kind of take advantage of that capital so that that capital has a vehicle to be funneled into. I think all of that will happen and continue to happen regardless of whether or not we see interest rate movement in the second half of this year. It's really about this massive, massive pile of capital that has yet to find a home because none of it can get comfortable with the risks that are kind of present in the market, and a lot of those risks that we talked about. And so this is really kind of another reason we're talking about ways to operationalize risk management into your system, is because some of these investors actually just need an opportunity to place this capital. And so this is a way to kind of get that capital comfortable with making some of those decisions.
Great. Thank you so much, Kelsey. That's all the time we have today. So thank you everyone for joining us, and we'll see you next time.
Thank you.